Viewers, in this segment, we're going to be taking your portfolio queries by our experts, as we have always tried to answer your mutual fund portfolio queries. So we'll be taking it up shortly. And while we continue to take your queries today, we'll first discuss the 5 key terminologies that you should know before investing in mutual funds. This is a common phenomenon because when I ask somebody how do you go about investing in mutual funds, the common answer is that seeing the past returns or reading some articles, they do and go invest in some of those top rated mutual funds. So if you do this DIY thing, what are the 5 terminologies that you should be focusing on? Let's take that discussion forward with Mr. Amul Joshi, who is the founder at Planned Rupee Investment Services. Amul, great to have you and very good evening to you. That's one thing that I'm looking forward to, and like I was telling our viewers that most of them try to invest in mutual funds on a DIY basis. So is this what you feel or what you encounter also?
Well, yes, Srishti, good evening. That's true. With the advent of technology and the information explosion that we have seen, that has percolated down even to the investor community. And you're right, we meet a lot of investors who are exploring the DIY option.
Well, Amol, you have been tracking the mutual fund industry, working in the industry for long, and you must have faced a lot of queries by those investors.
Sure.
So what is the first thing that you should want to tell our viewers, that going for mutual fund investment, that's one thing that they tend to ignore?
All right. See, one of the first things that an aware investor, a DIY investor these days asks is typically about what are the charges? You know, that's the typical question. Now, this is where the good news comes in. In mutual fund, I would say that one of the first things that you should, if you are a DIY investor especially, one of the first things that you should familiarize yourself is the TER. Now, that TER stands for total expense ratio. Running a mutual fund, if you have a broker or advisor or a distributor, there are certain commission element that is also paid to the distributor, MFD, mutual fund distributor. And as I mentioned, actual fund running expenses, or you can call a management charge, all these charges, which you are otherwise used to looking at them separately in a product like ULIP or insurance, all of those charges in mutual fund actually devolve into something called as TER. TER, I'll repeat, total expense ratio. And total expense ratio for some of the funds like liquid funds can be as low as 0.2%. In the sense, just to put things into perspective, if you invest in a liquid fund an amount of 1 crore rupees, if the TER is 0.2%, 0.2%, I repeat, your charges of managing that mutual fund that a mutual fund will charge you is 20,000 rupees per crore per year. If your investment horizon is of a lower, for 6 months, 3 months, the charges will comparatively be lower, proportionately be lower. So TR, I think, is a very important term right off the bat. That's what I would suggest DIY investors get familiar with.
Okay, but when it comes to tracking the returns, what we generally see is maybe the 1 year or the 5-year returns. But what is the correct approach to that? And what term do you use regarding when it comes to tracking the returns for your mutual fund?
So again, Srishti, this is very important point. I think during the opening remarks also, you mentioned most of the investors do look at past performance only. And within past performance, most of the times what gets displayed prominently is a 1 year, 3 year, 5 year sort of a return. Now, when we are sitting on, let's say any number, let's say we are sitting on a 25th November, a 5-year return simply means that if you had invested on 25th November 2017, exactly 5 years back. But as we all know, investment is an ongoing process. Nobody does it on one particular date, and definitely not all of them would do. So when somebody says 5-year return, that 5-year return in a common terminology is called as a point-to-point return. So 2017 to 2022. Now, the real deal is if somebody has invested in 2011, 12, 13, 14, 15, 16, 17, all the way, and each of that iteration, what would be the 5-year return? So you want to know, nobody can predict the future. Neither you nor me nor any investor can predict the future. So we want to know, investing in any particular fund, with a 5-year horizon. Now this horizon can vary. You can have and the term, for example, you asked is rolling return instead of point to point return. So you can have a rolling return of 3 years, 5 years, or any such duration. So rolling return actually tells you what is the average return or highest return or a lowest return generated by that particular scheme on multiple durations of 5 years each.
Okay, so that is something very interesting. But the third one, Amol, we discussed to highlight for our viewers is the duration in debt funds. What exactly is that, and why is that important to track?
Right. So this is again very important. In equity, many of the times people are familiar with a diversified equity fund, or let's say a sectoral equity fund, or a large cap fund, or a mid cap fund. In debt, however, most of the people think that a debt fund or a fixed income fund, most of the people think that those funds will be similar because there is no risk involved. There is at least no equity risk involved. Let me correct that statement. But suffice to say that debt funds can be as short horizon as 1 day. There are funds called as overnight funds, and they invest into securities that actually mature overnight. So you invest an amount today, you get maturity amount, capital plus interest on the next day. 1 year, from 1 year, you have funds that invest into as long as 10 or 20 years old maturities also. Now, duration, simply, there are various terminologies. There is a terminology called modified duration. There is something called as a Macaulay duration. But suffice to say that you need to find out whether a debt fund that you are investing into suits the duration, whether you want to invest for 3 years, whether the fund invests into substantially smaller maturity or substantially longer maturity. As long as you mention a kind of, I would say, uniformity between your duration and the duration of the fund, I think your results would be better than excessively higher or lower duration in a debt fund.
Okay, so we have discussed how to track equities fund, now the debt funds, but if I want to have a place where I can track all of my holdings, what would that be, and what term will we use in the mutual fund industry for that?
Right. So the term that we use, and this is something very unique to mutual fund industry, the term that we use is CAS, or popularly called as CAS. CAS stands for Consolidated Account Statement. Now, as you know, if you change couple of jobs, then you would have 2 or 3 salary accounts, and there is a chance that you invest in different mutual funds via different bank accounts. Maybe once your bank account changes, you invest via a different bank's portal, or your distributor or advisor changes. Now, across, let's say, longer period of time, let's say 5 years, 10 years, 15 years, you might have different combinations of bank account, distributors, advisors, and different mutual fund houses. Now, CAS is something, it populates, or it actually captures all your mutual fund investments with that are under the same PAN. Obviously, as we know, PAN is a unique number that is constant across our bank accounts and all other KYC and every other element of the financial life. So CAS encapsulates all your mutual funds across all the brokers, distributors, bank accounts, and sends a monthly statement on your email ID. And as you rightly said, this is one place, this one PDF is where all your investments will reflect. CAS is very, very useful. Investors who have experienced pains, those who have multiple bank accounts or multiple insurance policies, all those investors are pleasantly surprised when they say all mutual fund statements into one PDF.
That's very interesting to see. But Amol, from the 5 points discussed, that brings to the 5th point to be discussed. Till now we have discussed TER, duration in debt funds, rolling return, as well as CAS. But sometimes when we do the DIY mutual fund investings, investors tend to get confused between the Multicap and the Flexicap. So just wanted you to highlight the difference between the two so that our viewers can be helped on this front.
See, you're actually right. I have heard people using Multicap and Flexicap interchangeably. So this is once and for all, let's clear it up that Multicap funds and Flexicap funds are different. Now, as the word multi suggests, as well as Flexi suggests, these are the funds that invest into large cap, as well as mid cap, as well as small cap shares. So that is one common thread between these two funds. But within multi-cap funds, it is a regulatory mandate that a large cap, mid cap, small cap, each of the component has to be minimum 25%. So within these 3 components, 3 market capitalization brackets and 25% each, 75% allocation is kind of fixed. And remaining 25% is where a fund manager can exercise the discretion and go large cap overweight or underweight on small cap or any similar combination. That is multi-cap for you. Flexicap is truly, it truly gives the flexibility to a fund manager. Now in Flexicap, if a fund manager has a view, going forward, mid caps and small caps will perform better, then without any cap of 25% that is present in multi-cap, then fund manager can increase large cap and mid cap, mid cap and small cap exposure to something like 60, 70, or even 80%, and a smaller component can go into large cap or vice versa, depending on the call that the fund manager has on the market. So multi-cap is 3 market capitalizations, 25% each minimum. In Flexicap, no such restriction.
But with this, that brings to our discussion where we were highlighting the top 5 factors that you should be looking out for, or rather 5 terms that you should be noting down when you are going for DIY mutual fund investing. But let's kickstart our queries segment, Amol, and the first query that's coming to us is from Ritesh. He's currently investing rupees 10,000 per month in equity mutual funds, and he's investing in the following mutual funds. Let me just read them out. One is PGI Mid Cap Fund for 5,000 rupees, Axis Bank Blue Chip Fund for another 3,000, SBI Magnum Mid Cap Fund for 2,000, and he wants to have a corpus of rupees 12 lakhs in the next 7 years to pay off his education loan. In the last 5 years, he has amassed 5 lakh rupees. So should he stick to these funds? What's your view on that?
All right. So let's break it up into 2 components. First component is whether the investment, existing accumulated corpus of 5 lakh rupees and a 10,000 rupee SIP. Now, over next 5 years, this SIP as well as lump sum, if cumulative portfolio generates a 12% kind of CAGR, then amount will be in the actual end corpus will be in the ballpark of about 17 lakhs, 16.92 lakhs. Now, this is slightly higher, or I would say 30 to 40% higher than the actual requirement of 12 lakh rupees that Ritesh has. So I would say that's a good job, and there is a very good chance that you'll be able to pay off your educational loan. I just have a small suggestion over here. Since you will be significantly your corpus is significantly going to be higher than your actual requirement, I would say switch your existing 5 lakh rupees, switch in the sense, deploy your existing 5 lakh rupees into moderate equity exposure funds like a balanced advantage fund or a dynamic asset allocation fund. Your SIP, obviously SIP gives you rupee cost averaging, and there is no risk of a kind of a bulk amount getting a market hit if market were to go down suddenly. Then SIP should continue to pure equity funds. You can stay with the existing funds. You have a mix of a large cap fund and couple of mid cap funds. That's fine by me. But I would say that existing lump sum corpus, you can probably try to de-risk it by switching it to a balanced advantage or a dynamic asset allocation fund.
Okay, so that's the advice coming in for Ritesh. But the next question coming in from Siddharth, he says that he's 30-year-old right now and works in a private company. His monthly income is around 80,000 a month, and he wants to invest in equity mutual funds for a period of 20 years to build a corpus for 1 crore rupees. That's the target. And can he invest 30 to 40,000 per month right now? And he's looking out for some suggestions when it comes to mutual fund investing. So Amol, the stage is all set. What will be your suggestion to him?
All right, Siddharth. So this is a great, a young investor, 30-year-old, and you have a horizon of 20 years. Long-term investment actually pays off in equity. So that's something very good that I would, comment over here. Coming to your target of 1 crore rupees, over such a longer duration of 20 years, I would say SIP amount of 11,000 rupees per month over next 20 years. And if it generates a 12% kind of CAGR, I think your target of 1 crore rupees will be met. So out of your 30 to 40,000 rupees investable surplus, only 11,000 rupees is sufficient to meet this goal of 1 crore rupees. Remaining 20 to 30,000 rupees, you can obviously deploy to meet your other financial goals. Coming to your request for schemes, I would say this 11,000 rupees, which is for 20 years, I would give you a breakup of investing into a large and mid cap fund. Within that, you can look at HDFC large and mid cap fund. Please put 5,000 rupees out of the 11,000 rupees over there. 3,000 rupees into Motilal Oswal mid cap fund, and another 3,000 into Nippon India small cap fund. This is about 11,000. Remaining 19 to 29,000, I would really want you to kind of give it a thought as to whether that amount is coming handy for another goal. That goal might be 5 years, 7 years, 10 years away. Since the horizon differs, I'm keeping this list of mutual funds restricted only to your longer term horizon.
So those are the mutual funds, Siddharth, that you should be looking out to invest. And if you want to keep that tracking for longer term perspective, do see our discussion that we just had before taking the queries, where you should be knowing those 5 factors when you're going for mutual fund investings. The next question coming is from Syantan, and he says that he is a freelancer with a monthly income of 40 to 50,000 a month, and he wants to start investing in equity mutual funds with the target of building a corpus of rupees 30 lakhs in the next 15 years. He is also looking out for some mutual fund suggestions. Amol, what will be your suggestion looking like? And he has also defined his risk, that is medium risk he's willing to take.
Okay, so this is again very good to hear. I always say it is always recommended that you always take care of your, look at your risk profile, look at your investment horizon, look at your asset allocation before you make any investment commitment, be it over a short term or long term. So quickly about the schemes, I would say to accumulate a corpus of 30 lakh rupees in 15 years, SIP of even an 8,000 rupees with a 9% kind of a CAGR will get you that corpus. Now, some of the keen viewers would have deciphered that for previous examples, we spoke about a 12%, 11%, 12% kind of a CAGR. But since Sayantan has defined his risk profile as moderate, we are not going to kind of recommend pure equity funds for him. We would say that for moderate risk, you can look at balanced advantage fund. And for this 8,000 rupee, I would suggest 2,000 rupees into HDFC balanced fund, 3,000 rupees into Edelweiss Balanced Advantage Fund, and 3,000 rupees into ICICI Prudential Balanced Advantage Fund. Goes without saying, if your target to invest is 40 to 50,000 rupees per month, your other investment amount, your other SIP investable surplus should go into other goals, and you will have to define the horizon and schemes separately for that. But for this 8,000 rupees, I hope these 3 schemes will do the job.
That's the advice coming in for Sayantan. But with this, we are completely out of time in this edition of the ET Money Show, as well as it brings us to the end of the segment 3 discussion. Thank you so much, Amol, for joining us today on ET Now and helping us viewers have a better understanding for DIY mutual fund investing, as well as helping their portfolio queries.